Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. We haven't had a chance to talk China in a while, and the post-COVID Chinese lockdown developments occurring in China now merit it. Unresolved and overdue structural problems, primarily centered on labor, are now coming to the forefront. These are problems seldom currently mentioned outside China, but I will speculate will be common media narrative talking points within 6 months. As such, I like to cover the items highlighted here. Our longtime readers are certainly well aware of the importance that we at Matasi.com place on the Chinese credit impulse. Though it works within an approximate 12-month lag, it has signaled on 4 separate occasions over the last decade and a half that it would insert sufficient liquidity into the global system, which would help resolve major issues at that time. The 2008 financial crisis, the 2011-12 EU banking crisis, the 2014-15 taper turmoil, and in 2020 the COVID-19 shock. The question we need to answer is whether there may be a 5th time during the coming looming potential U.S. recession and global slowdown. With China now coming out of its own COVID lockdown and its economy regaining its footing, the specific questions are, will there be another Chinese credit impulse? 2, how strong will it be? 3, how long will it last? And 4, will it be sufficient to overpower a potential major global slowdown? China has been opening the credit spigot, but as of yet there is insufficient data to definitively answer these questions. We can, however, examine the challenges facing China and draw some conclusions on what China might do to resolve these issues, and as a consequence, what might be the spillover to the global economy. Currently, the economic picture in China is not positive. This is most easily seen by the macroeconomic surprise index, which is pointed almost straight down for China and the United States. You'll notice a cascading, starting with the EU, followed by emerging markets, then China, and most recently the US. The index suggests we have a spreading global problem. China still faces significant economic challenges. The contraction in real estate remains a major headwind, and there is still some uncertainty around the evolution of the virus. Longer-term headwinds to growth include a shrinking population and slowing productivity growth. As this chart illustrates, by the relative underperformance of Chinese equities compared to the U.S., emerging markets, and EU, many are not confident about the Chinese outlook. Momentum appears to only be getting worse. Even the Chinese currency is under pressure and appears to be headed for yet another leg down. We'll get into the details of why this is happening in a moment, but first we must talk about Chinese leadership. A common feeling is Xi Jinping's leadership is resulting in and I'll use a terminology many are using, peak China. This is because China's economic growth is seen to be dramatically decelerating, and there is much skepticism about Xi Jinping's ability to rejuvenate the country's fortunes. Forecasts of China surpassing the U.S. in GDP and becoming the #1 global economy are being revised. Xi's leadership is primarily responsible for the current state of China's economy, as his policies prioritize social fairness and party control over economic reforms. Xi's crackdown on private sector firms, especially in the technology, internet, and educational sectors, has had negative consequences for the economy. Xi's push to tighten state control over information and data raises risk for businesses and investors in China, and is limiting transparency and increasing uncertainty. According to Bloomberg, and I quote them, Wall Street's biggest banks face a harsh reality check in China. And they go on to say scaling back ambitious expansion plans and profit goals as a deteriorating geopolitical climate and President Xi Jinping's willingness to sacrifice economic priorities for security concerns rock the private sector and throttle deal-making, end of quote. Now, another quote from Bloomberg, there's now a realization that they need a fundamental rethink on the world's #2 economy because the business climate has weakened significantly and the best opportunities for making outsized profits in the country are over, according to senior executives. Publicly, everyone's saying the same thing. China is still a massive opportunity, and they have no plans to pull out, especially since so much money has already been spent. Another quote, privately, Wall Street executives are saying it's difficult to maintain good standings with both sides as tensions repeatedly flare, end of quote. Increasingly, China is no longer a top 3 investment priority for a majority of U.S. firms, according to the American Chamber of Commerce survey. And China is also now closing down cross-border trading apps to prevent capital outflows. The recent poor reopening numbers are highlighting multiple problems. Frankly, the reopening is losing its mojo. After a strong post-COVID zero rebound in the first quarter, the world's second biggest economy is showing signs of cooling, with industrial output, retail sales, and fixed investment all growing at a much slower pace than expected in April. The housing rebound is also fizzling, while the youth unemployment rate soared to a record high and is likely only to worsen. Expectations are for real GDP growth to accelerate to 6% year-over-year in 2023, on the back of China's ongoing post-reopening recovery and policymakers' continued focus on growth. The easy part of the recovery is behind China, and some persistent weaknesses in the economy around the property sector, youth employment, and consumer confidence will require more targeted policy support to counteract. We'll get back to these weaknesses in a moment. Recapping China's latest data, we have China's April activity and spending data significantly disappointing expectations. Retail sales rising to 18.4% year-over-year in April, improving from 10.6% year-over-year in March, but missing consensus estimates of over 21%. Industrial output rising by 5.6% year-over-year in April, rising from a rate of 3.9% in March, but short of the 10.9% estimate on the recovery. Rate of urban investment has been pared to 4.7% year-over-year in the month, missing expectations of 5.5%, and urban unemployment rate falling marginally to 5.2%. According to Capital Economics, and again I quote, growth on most indicators accelerated in year-over-year terms in April, but this was due to a weak base for comparison from a year ago when Shanghai and several other cities went into lockdown in seasonally adjusted month-over-month terms. It was mixed. Also, the recovery in consumer spending regained some momentum and investment growth held steady, but industrial activity contracted. While the boost from reopening should still underpin a further recovery in the near term, the bulk of China's rebound is now behind us. The recovery still has some legs, although will likely fizzle out in second half as fiscal support is being unwound. The rebounding credit growth is stalling, while the housing market appears to be struggling for momentum, end of quote. Separately, they go on to say that global economic challenges may prevent a pickup in Chinese exports. China's imports contracted sharply in April, while exports grew at a slower pace, reinforcing signs of feeble domestic demand despite the lifting of COVID curbs and the cooling global growth. Inflation may not spike from here. China's reopening was thought to be an inflationary catalyst, but that has not come to fruition. The key is the lack of fiscal stimulus and a reopening impulse that has dissipated quicker than expected. The approximately 20% youth unemployment also means that you are unlikely to have an analogous wage spike like you saw in the United States, where minimum wage increases, both statutory and voluntarily, were the primary factor. JP Morgan cut its Q2 GDP forecast from 6.3% down to 3.5%, and fiscal year is now down to 5.9% from 6.5%. Separately, the Black Sea Grain Initiative is another situation that has the potential to spike ag prices. The agreement has been renewed for 2 months. Corn, soybeans, and wheat all sold off in response. The biggest risk to this thinking is acceleration in core services in the June CPI print, triggering yet another rate hike. There seems to be strong evidence that we have at least a short-term peak in China. Let's jump to some policy prescriptions now, and where they may lead us in our quest in understanding what's going to happen with the Chinese credit impulse. To jumpstart the economy, Chinese leaders must move beyond the familiar playbook that calls for boosting exports and government investment stimulus, without first addressing the problems of household underconsumption and sluggish income growth and public pessimism about the future may offset the positive effects of export growth and government stimulus, holding back economic recovery. Chinese household consumption was a solid growth driver, supporting nearly 40% of Chinese GDP over the past 2 decades. China's rising consumer class was willing to spend more on aspirational goods, confident that their incomes would continue to grow. They were right. The Chinese economy maintained an average of 9% annual GDP growth rate for nearly 2 decades between 2000 and 2019. As a group of Gallup researchers observed, using data from a 10-year national survey of the Chinese people, about 3.5% of Chinese households had annual incomes of around 30,000 yuan, or about $3,800 in 1997. This number skyrocketed to more than 12% in just 5 years. Researchers found a continued strong consumer appetite for both must-have items and discretionary fun. Until roughly 2017, household consumption growth never lost steam, but during Chinese President Xi Jinping's second term, Chinese households experienced the worst slowdown in consumption growth in a generation, dropping from 6.7% during Xi's first term to 4% during his second term, considerably slower than GDP growth. Although the nationwide lockdowns and supply chain disruption have certainly contributed to the downturn in consumption, the Chinese government's regulatory crackdown on the tech industry, combined with China's worsening external environment, have also fueled an unemployment crisis, especially among young people. The gap between consumption growth and GDP growth has widened since the COVID-19 pandemic hit. Before the pandemic, China's real per capita consumption grew at an average annual rate of 6.4% from 2013 to 2019, 59 basis points below the average annual real GDP growth rate of 6.97%. This gap increased 170 basis points from 2020 to 2022, when GDP growth dipped sharply to 4.5%, but consumption plummeted at 2.8%, less than half the rate before the pandemic. 2020 saw Chinese household consumption experience the sharpest contraction in growth since the 1990s, even though China was the only major economy to see economic growth that year. As sharp as the pandemic's impact was, declining income growth has been the real driver of shrinking consumption during Xi's years. The average nominal annual household disposable income growth rate fell to 8.39% from 2013 to 2022, from the average rate of 11% from 2001 to 2012. Chinese households are all experiencing the worst material stress as income growth stagnates and are more insecure about their economic security than at any time since 1990. In November 2022, China's Consumer Confidence Index plummeted to a record low of 85.5 points. China's exports have boomed, but that hasn't helped ordinary households. This suggests China cannot export its way out of an economic slowdown or stimulate its way towards an economic boom. Boosting export growth is important, but its marginal effects at this point are limited. China became the world's largest exporter in 2009, and in 2020, China's share of global goods exports reached 14.7%, more than the shares of the United States and Japan combined. China's exports to GDP ratio peaked in 2006 at 36% and since declined below 20% between 2016 and 2020. Even if China could increase its service exports while maintaining its dominance in goods exports, there is only a narrow space for the export to GDP ratio to rise, as China's GDP growth and supply chains relocate out of China. A report by New York University Stern School of Business and DHL projects China's export growth rate to decline from 6.6% from 2016 to 2021 to 3.4% from 2021 to 2026. The usual government solutions to hard economic times has been major stimulus packages. But over the past 14 years, these have exacerbated local government indebtedness, chained financial stability to an unstable and often corrupt property market, shrunk fiscal space, and raised the amount of credit necessary to stimulate growth for future crisis response. China's two major economic stimulus packages offered a temporary boost, but had long-lasting negative consequences. In the wake of the 2008 financial crisis, the Chinese government deployed 4 trillion yuan stimulus, or about $586 billion, between November 2008 and December 2010. This stimulus boosted growth to 8.7% in 2009 and 10.4% in 2010, and it gave China the final push to overtake Japan and become the world's second largest economy in 2010. However, this short-term growth came at the cost of ballooning local government debts and rampant expansion of local government financing vehicles such as LGFVs that we've talked about previously. These are investment companies owned and provided with capital by local governments for the purpose of issuing debt in bond markets and financing property developments and other local infrastructure projects. Because the primary lenders to LGFVs have been banks, a large-scale default of LGFVs could trigger contagion in the banking sector. Additionally, debts raised by these can be more susceptible to corruption because they are kept off local governments' balance sheets. The 2015 to 2016 credit expansion to save the stock market crash amid a housing market slowdown was estimated to have cost at least 5 trillion yuan, or another $805 billion. Despite costing more, the effect of this was weaker than the first round of stimulus and aggravated the legacy problems of the previous 4 trillion yuan in spending. The International Monetary Fund research shows that the price to generate the same amount of nominal growth from 2015 to 2016 more than tripled the cost in 2008. During the pandemic, the Chinese government strongly encouraged local governments to take advantage of the special purpose bonds introduced in 2015 as a form of off-budget financing that local governments use to issue bonds and raise capital to finance a particular policy or address a certain problem, to front-load the economy with more infrastructure investment projects. Bloomberg estimated that China's stimulus through various financial and monetary support amounted to 35.7 trillion yuan, or 5.3 trillion American dollars, by the end of May 2022, in addition to the 30 trillion yuan stimulus in 2021 and 37.5 trillion yuan stimulus in 2020. In August 2022, the State Council added another 300 billion yuan in credit support using its policy banks. All of these credit expansions with record-breaking exports only generated 3% growth in 2022, but at mounting costs, the result of a proactive fiscal policy for over a decade, since 2008, is that about a quarter of Chinese provinces will spend more than half of their fiscal revenue on debt repayment by 2025, as the former Chinese finance minister has recently warned. Previous credit expansion schemes also aim to support major corporations, not to boost private consumption or provide household support. As a result, Chinese household income growth and consumption growth fell behind GDP growth. Although the U.S. government pandemic relief measures were also primarily targeted at corporations rather than households, many American households received greatly increased unemployment insurance as a cushion. However, this option was not available for the hardest hit millions of unemployed migrant workers and recent college graduates in China. In this context, Chinese leaders' recent shift over the last year to prioritize private consumption for economic recovery is the right policy move. but it comes with some serious consequences to the global economy. The government issued two critical documents about consumption. In April 2022, the State Council released the opinion, shown here, the opinion on unleashing consumption potential and promoting sustained consumption recovery. The report mentioned 20 measures in 5 areas to promote consumption, providing implementation guidelines for local governments. In December of 2022, the day before the Central Economic Working Conference, the National Development and Reform Commission published the Strategic Planning Outline for Expansion of Domestic Demand between 2022 and 2035, which laid out 38 measures to boost domestic consumption in 11 areas over a 12-year horizon. While acknowledging the critical role of investment, the outline put expanding household consumption before effective investment as a long-term strategy for the very first time. As of the December 2022 CEWC, policymakers reaffirmed their intention to prioritize supporting household consumption over investment and export. One way to interpret these policy announcements is that they collectively signal that Chinese policymakers have recognized the urgency of correcting China's underconsumption problem. If this is true, then this year could be a watershed moment as the government pivots towards prioritizing household consumption over exports, which was China's growth strategy since 1978. But changing the course of government priorities in China, especially ones deeply mixed with local government finances, can be a slow and tangled process at best. And even if Chinese leaders genuinely attempt to prioritize consumption, then they face two primary challenges: financial repression and household balance sheet deterioration. Since Deng, 3 generations of Chinese leaders have established a system of financial repression that suppresses consumption, forces savings, and prioritizes export and state-led investments. At the operational center of China's repressive financial system is state-owned commercial banks, whose primary customers are state-owned enterprises and have little experience in promoting relationship banking. Take the episode in 2022 when the Chinese banks offered loans to companies and then allowed them to deposit funds at the same interest rate. Or the time when Chinese banks inflated their loan numbers by swapping bills with one another to meet regulatory requirements for corporate lending. Both are sad evidence that the only type of lending that Chinese banks know how to do and are allowed to do in the current system is lending to enterprises. And when demand from enterprises is weak, well, Chinese banks are incapable of channeling credit to anyone else, especially consumers. The balance sheet of the average Chinese household has gotten increasingly dire over the last 15 years. Household net asset growth has decelerated since 2010, a problem that worsened during the pandemic. A report by a Chinese securities firm estimated that between 2011 and 2019, Chinese household net asset growth rates dropped to around 13%, from close to 20% before 2008. During the pandemic, household and net growth sunk below 10%. Most of this wealth is concentrated in the country's increasingly shaky property sector. A urban household balance sheet survey conducted by the People's Bank of China in 2019 showed that housing was roughly 70% of household assets, with mortgage loans accounting for 56% of total household debt. This level of indebtedness was comparable to the United States in the run-up to the 2008 subprime crisis and the burst of the real estate and stock market bubble in Japan in the 1980s. Between 2008 and 2022, the Chinese household debt to GDP ratio increased from nearly 18% to 62%, equivalent to an annual increase of 17.6 percentage points. Chinese household debt reached all-time high of 62.4% in GDP in September 2021 and has since maintained above 62% of GDP. IMF research showed that higher household indebtedness boosts consumption growth in the same year but reduces it after 2 years, then acts as a severe drag on consumption, even when income grows. Household debt has also risen faster than income growth. Between January 2007 and December 2022, Chinese household debt increased from $517 billion to $10.8 trillion, amounting to an annual compound rate of nearly 22.5%. During Xi's first 2 terms, household income grew at an average real rate of 6.25%. In contrast, the household debt-to-income ratio increased from 68.7% in 2013 to 161.5% as of September 2022, higher than the U.S. ratio of 119.8%. From 2011 to 2021, driven by fast-growing mortgages, the Chinese household leverage ratio increased by 33.8 percentage points, the fastest increase in the world. Between 2012 and 2021, household debt increased at an annual rate of 18.3%, whereas income rose only by 10% annually. Fast-growing household debt, combined with pandemic lockdowns, salary reduction, layoffs, and major policy swings, has exacerbated Chinese household financial insecurity. The most unfamiliar and most challenging problem for Chinese policymakers is not decoupling or weakening exports. The real test comes at home. How to incentivize and persuade disheartened Chinese families to contribute to economic growth by expanding household consumption. The government has previously mobilized households to boycott foreign goods or travel, but it can't mobilize Chinese people to spend more when many have become increasingly insecure about their economic future. What we haven't been able to focus on yet is that China has a secular labor problem. It is twofold: rising labor costs cutting into margins while maintaining pricing competitiveness, and 2, full employment with surging and serious youth unemployment. In China, the government is expected to deliver jobs. Without achieving that, the CCP loses its political authority and seriously weakens its power. To place the problem into perspective, we need to appreciate that the U.S. has a population of approximately 334 million, with 161 million people working. China has a population of 1.4 billion people, but has 734 million people working. Think of the magnitude of problem China has when the economy slows or foreign exports weaken, with razor-thin margins, because China built its manufacturing power on cheap labor and tight margins. Never mind when you have to be forced, therefore, to lay off. The layoffs are 40 million people. I can remember in 2008, at Christmas, China had 28 million people unemployed at train stations. It was a major issue. They were trying to get home. For years, China had nearly 50 million new workers leaving the rice paddies and heading to the cities for work that at least paid a subsistence wage. Yes, at the end of last year, China was coming out of their COVID lockdown, but still reported a reduction in labor force of 1.3 million jobs. A reduction. Well, that is a lot of angry, out-of-work people without subsidies that we were giving during COVID lockdown. What about the millions looking for new work? Just looking at youth unemployment, which I've mentioned a number of times now, it has a staggering level of 20.4%. China is graduating millions from their universities who can't find jobs. Meanwhile, overall wages for those actually working has grown by 9.7%, which is hurting their cost price points. As part of Asia, which is now delivering 70% of global growth, China is fiercely competing with the other Asian tigers. That battle has now reached the point of being almost tied, with each at approximately 50% of that pie. The bottom line is that China has a major and serious problem it must quickly solve before social unrest becomes unmanageable. Remember Tiananmen Square? These are not problems that stimulus or capital investment will solely solve if the global economy slows and the U.S. heads into a recession. Never forget that as a 70% consumption economy, the U.S. is the dominant source of global demand that everybody is living off and the supply chain is driven to accommodate. The U.S. consumer has never let the world down by increasing consumption more than it produces. Those days, however, may be coming to an end. minimally for a time sufficient to cause significant disruptions. So what can we conclude? Not all news out of China is bad news. There are some encouraging signs. However, to answer the questions we started with, will there be another China credit impulse? How strong will it be? How long will it last? Will it be sufficient to overpower a potential major global slowdown? China's credit impulse experienced a much lower peak in 2022 than during prior cycles, reflecting this important policy shift. After adopting counter-cyclical policies, which involved large fiscal stimulus and credit boosts during the economic slowdowns, for over a decade, China's policymakers have gradually adjusted their policy approach to cross-cyclical adjustment. This strategy emphasizes preemptive, nimble, targeted, and long-term focused policymaking and avoids excessive and ineffective stimulus. That's where they're going. And that's going to impact the credit impulse. Global investors may be disappointed as the policy shift implies China's economic growth is unlikely to revert to the elevated levels seen in the last decade. However, slower growth is not necessarily a negative development. The previous adoption of counter-cyclical policies often left the Chinese economy veering from sharp upturns to significant slowdowns, rendering it reliant on easy money. Sounds like the United States. Now, with the adoption of the cross-cyclical adjustment framework, investors should expect that China's credit growth trajectory will be managed such that it doesn't lead to boom-bust cycles and excessive leverage. The country should emerge with a stronger balance sheet and less financial risk. The seemingly prudent and positive policy actions have resulted in a stable outlook for China and appear to make the country a bright spot amid significant global economic uncertainty. Investors treating China as a key diversifier of global portfolios should return focus to organic economic growth and bottom-up fundamentals instead of speculating on large policy stimulus. The bottom line is China's global role is changing. Yes, China's reopening will support near-term resilience in global growth this year. However, the spillover to global demand of China's recovery will be different this time. The main driver of recovery is not investment, but household consumption, which has much lower import content. That means less of an impact on worldwide commodity prices and inflation. Still, it would be a mistake to see this as evidence of a more specific decoupling between China and the West. In fact, global trade has reached new highs over the last 2 years, even though China's share of U.S. imports has declined somewhat since the imposition of tariffs. Much of the talk about multinationals leaving China is frankly simplistic. Some are setting up a separate supply chain for the U.S. in order to avoid restrictions. Others are switching to a China plus one strategy, retaining China as their main source of goods while building an additional supply chain in another country like Vietnam. Many are doing both. For most international companies, China is simply too big to ignore. In conclusion, China's recovery will be different this time. Growth will be slower than in the past, but also higher quality as spending shifts to consumption in new sectors. This will create fresh opportunities, but China is not going to save the U.S. and the world again this time by helping them with their demand. China will be focused on saving itself and increasing its own domestic demand. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will actually take that money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has actually seldom been a better time for investing. However, it requires careful analysis and not following what may have been traditionally and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2023 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.